listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. I'm really excited to have my next guest with us. He's one of your favorites, one of my favorites also. Greg Weldon, CEO of Weldon Financial. Greg, I want to get right into it. I think the last time we chatted was last summer. I could be wrong. Looking at the gold setup right now, technically, fundamentally, to me, it looks like the best setup I've ever seen for this market. Now, I know that might be over the top, but you've been doing this much longer than I have, and I love your take on everything. So I just wanted to start off with that get a big picture view out of you and see how you're looking at gold right now.
Well, I'm looking at gold as the next phase of a sector bull market that's going to take us much higher. We've been bullish on it for a while. There's been some dissatisfaction among the gold bulls that, gold hasn't broken out already with some of the stuff that's been going on. But I think if you look at gold's performance in the face of what at one point was a 20% year over year rise in the dollar, gold held in pretty well by being down less than 10%, right? When you look at the gold adjusted value of the dollar, it's often a proxy for monetary conditions. And I think really when you look at the Fed, I have it's kind of a polarized view on the Fed, because Jerome Powell told us what he was going to do all the way back in 2018. The Fed published over 300 pages in 11 different white papers on the new monetary policy paradigm. All right, I read every word of it, and I don't think too many people did. It was one of the papers had only like 600 downloads, and I was one of them. But the point here is they were very clear. They said, we are going to let inflation run. We're going to let it run as high as it wants. We're going to use the longest term moving average on the choices that we have. So it's an 8-year moving average is what they're going to base the, kind of where you're at on inflation. And then, normally some of the central banks that have implemented this kind of plan in the past have what they call tolerance bands. In other words, okay, we're going to say, we're going to use the average, which is 1.5, and we're going to let it go 4 percentage points, either way relative to 1.5. In other words, if inflation gets to 5.5, then we're going to cap it. All right, we're going to try and do whatever we got to do immediately to stop it. Well, the Fed chose not to use tolerance bands, really, which are really intolerance bands, if you want to really get into the nitty gritty of it all. But they said we're going to let it go as high as it wants. We're going to let it stay there because we know how to get it down, and we need inflation. Now, I think the Fed's mistake was they didn't really, count COVID and supply chain issues for as much inflation as it contributed. And they started way too late in their tightening phase. They stuck with the word transitory, which was the worst possible word they could use, for way too long. They were late to the party. And then the first move was only 25 basis points. It's like, come on, give me a break. They were so far behind the curve at that point, you knew that they had to get, much, much more aggressive. Powell then came out and, shifted the paradigm a little bit and said, we're going to keep raising rates until we get restrictive, and then we're going to stay there for a while. Well, they're not even restrictive yet, although they've gotten a lot closer. They raised rates so much that they, caused some issues with the banks. All right, we'll talk about that in a second. But really, in terms of policy, because this is where it gets important, they lifted the top end of the Fed funds band now is 5%. PCE was reported on Friday, just came down to 5%. All of a sudden, the Fed usually use R star to determine where neutrality is. That was part of the 300 pages that I read in 2018, all about R star. There was 2 of the papers were just on R star, which is a formula that gives you what is the neutral interest rate. And the Fed figured out that the neutral interest rate for the U.S. is 25 basis points above the rate of PCE inflation. So right now, neutral would be 5.25. They're at 5. Inflation is going to come down. We know that the base effect is only just now kicking in. We've seen it in Europe big time in terms of energy, and it's going to hit the U.S. And you're going to see inflation come down, probably to maybe even a 3 handle. Inflation expectations come all the way down to 3.6 in the latest University of Michigan, right? So if you start looking at that as a proxy, because actually the consumer's been pretty good at predicting inflation over the last year, believe it or not, a little bit after the fact, but they've been ahead of the game at times. So let's say inflation falls below 4, which is not unrealistic given the base effect just in energy. I mean, you'd have to have a massive rally from here to negate the base effect, which could happen. I mean, it happened a year ago. And that's part of the Fed's problem is they didn't catch that either. But if you get inflation to 4 or say even a little below 4 on the PCE, which would be equivalent of 4.5 to 5 on CPI, you're going to have the Fed funds rate 100 to 125 basis points above the rate of inflation, which means they are restrictive. And they're restrictive into a recession that's starting, right? And I tell you what, Jordan, you know how deeply I dig into the data. The data is horrible from the last 2 weeks. All the Fed regional bank surveys of service sector, retail, and manufacturing, awful. Today's ISM service sector confirms it. All right. You're seeing a rollover in the economy that is, not surprising. And yet some people seem surprised. I mean, so it's kind of funny to me. But in that context, that's part one of this answer. And it's a long answer, but I think we're going to cover a lot of bases here. Part two is the bank situation that just came out of nowhere, okay, which, of course, it didn't come out of nowhere, all right? I mean, we could say this is 50 years in the making. This goes back to 1971. All of it does, right? But the bottom line is if you use all the deposits, they say 17 trillion. There's actually like 19.3 trillion of deposits that would theoretically be insured. And you have 0.128 trillion in FDIC money. That's like saying I got a $20,000 hole and I got $150 to cover it. It's absurd. You can't print that much money, right? Janet Yellen kind of finally made that admission publicly, right? So the point here is what you're seeing is a unprecedented record outflow from deposits. It hit a point where it was over $750 billion in 13-month period, all right? To offset that, banks started selling securities. They've sold over $500 billion of securities in the last 12 months, most of it in the last 2 months. What they haven't done is cut back lending until the most recent weekly numbers showed a decline in credit, at bank credit. That's not considered securities or cash or all these things. If you take the amount of cash they have, 3.2 trillion, the amount of securities they hold, 5.7 trillion, you come up with about 8 trillion, which is less than half of what is known to be the deposits. Let's be conservative and say, 17 trillion. I mean, what are you going to do? Call in loans? I mean, you have a serious hole here that is, developed over time. I would say it's not even as bad as 2008 because back then every deposit was credit. All right. You actually have some cash. You have some securities. You didn't have that back in 2008. So it's actually healthier, if you want to call it that. But I would say that's like walking into a 600-degree room instead of a 1,200-degree room. Either way, you're going to burn up in, milliseconds. All right. It really doesn't matter. It's still a big hole. So when you combine these two things, there's two things that are certain. Number one, that more volatility is coming. It's a natural phenomenon. It actually has a lot to do with physics and just chemistry on this planet. But when you tie that in with more QE, Jordan, they're going to have to print so much money, let alone, we've talked about this on your show before. I'm one of the first ones that have been talking about this. It's been talked about for years in terms of China playing the debt card, dumping bonds, all the things they could do. But it was always mutually assured destruction. They're not going to do it because they blow themselves up at the same time. That's not the case anymore, man. They're the most imports of anyone, on a monthly basis. They're the biggest exporter on a monthly basis. The second they say we want renminbi for all our exports, the dollar crashes and everything goes to hell. All right. And gold is $3,000 an ounce minimum, right? So you have all of these things working at the same time now. All right. QE coming because the economy's rolled over. And QE coming at a time when inflation is this high fits into the thought process that it's a 40-year trend reversal. Lower lows and lower highs in interest rates and inflation since 1982. That trend is reversed, and you're now going to have higher highs and higher lows because the Fed is going to get off their tightening. They're going to shift to easing. They're going to be forced to quicker than they want to. They're not going to be able to stay restrictive and pump out every ounce of inflation. Now, stock market crash could be deflationary to maybe we don't worry about inflation. All right. There's all kinds of possibilities here. But the bottom line is Fed policy is now skewed to acquiesce to higher general rates of inflation. And it will shift from, fighting inflation to protecting the economy and the consumer because the consumer has tapped out his savings. He has borrowed to the nth degree. It's been record consumer credit creation in 2022 off the charts, like mind-numbing numbers that we've never seen before. And wages, the second you get a paycheck, it's worth less the second you get it to the bank to cash it. So all these things are not going to go away. And what it creates is a phenomenal situation of anxiety over banks, anxiety over paper money, anxiety over the debasement of the purchasing power of paper money as they print more and more and more, which they will be forced to do, let alone, the totally disenfranchised bond market, the totally out of balance bond market, supply demand. They're going to have to buy bonds just to keep the bond market from blowing up. All of this is lower dollar debasement in purchasing power, and that is bullish for gold. And frankly, it's bullish for silver. It's bullish for Bitcoin. It's bullish for Ethereum. It's bullish for all the things. Say you want to take your money out of the bank. Say you're worried about the banking system. You want cash, right? Are you going to get cash and stuff in your mattress? Well, it's going to be worth less the second you decide to spend some of it. But yeah, some people might do that. You're going to go get cash and go to the bullion store and buy silver bars, gold coins, whatever. Yeah, some people will do that. The majority of people out there, all they need is a phone and an electronic wallet, and they buy Bitcoin, and it's out of the banking system to whatever degree, that's true. So I actually like Bitcoin and Ethereum here the same way I like gold and silver. I think gold is always preferable because you can hold it. Say you have a solar flare, knocks out the electrical grid. Well, your Bitcoin's not really going to serve you well in terms of getting food. All right. Now, I'm not doomsday scenario where the bank system is going to collapse. I think this is a slow bleed over time, and gold just keeps going up. As well as I do, man, the open interest is really low still. Nobody owns this stuff, man. So from that perspective, it's a case where what we saw yesterday was investors chasing this market. You had the big run up here to $2015 just recently, right? And then you came down like $60, $65, $70. Open interest came down by like 50% of the gain. It's like people dump so fast. They're so afraid of gold because of the false starts that we've had, which we've had. But that was when the dollar was going up, man. Right now, the dollar's about to break. Par 82 on the dollar index, $19 on the UDN, which is the dollar ETF. It goes up when the dollar down. It's a great play. And when that happens, gold is already going to be record highs. It's really bullish scenario, Jordan, and I agree with you. Long answer short, I agree with what you said. It's one of the best setups ever. I've seen better, back in actually 1999 and way back in, frankly, in, the early 70s, which I remember. I'm that old decrepit, even though I don't, thank God, don't look that old decrepit yet, but still. So long answer short is I agree. It's an unbelievably bullish setup. And the only thing I worry about is it actually like too bullish? Is this setup too bullish and too obvious and everyone's going to get led to the slaughterhouse? I just don't see it. I don't see any froth. I don't see any excitement. I don't see people with huge long positions here yet. They're going to be chasing this market higher.
Okay, you mentioned silver a little bit. One question I have for you is, so we know that a recession is coming, and we know that in that type of environment, gold will outperform silver. At least I'm speculating. I mean, we can't predict the future. But so to me, I'm thinking, how does a potential recession impact silver, given that, looking at gold has basically, I mean, there's like no overhead resistance, right? It's getting into new all-time high territory. But if you look at silver, I know you look at this, the monthly, weekly, quarterly charts for silver, there's a lot of resistance it's got to chew through, $26, $28, those levels. So I'm just one, I know we can't predict exactly what's going to happen, but that would be my one concern as a gold bug and silver bug. How is silver going to be impacted, by this coming recession?
Well, I mean, it's always a risk, as an industrial metal that has applications, certainly in technology. Tech stocks get whacked. That's it seems to be a negative, although I'm not sure it's a real bad, it's overwhelming negative. I mean, gold silver ratio is below the 2-year moving average. It's come down from above 90 to 80. So, I mean, it is coming off. It is threatening to break down here. I think the experience, really over, so that would suggest, that silver is going to maintain here and going to play ball here for at least now, because I think there's much more a monetary dynamic, a back dynamic. A Fed has to be the backstop dynamic. So I like it now. But yeah, when you hit into a recession and the stock market gets whacked, that's when you'd rather own gold, because you could be in a situation where everything goes down. And it's like 2008 before gold and silver took off, when the Fed finally came with, tarp and talf and $1 trillion worth of money printing. If you remember, at first everything went down and gold went down too. It just went down less. Stock market was down like 45%. Gold was down like 25% at most. So that scenario is very real. It's not like there's no risk in gold. There is risk, and it is the stock market, frankly, if you ask me. But that also then turns the tide at some point where it creates a tremendous buying opportunity for the people that missed the move. And I would hope that we would see that coming and we would kind of take profits. We're not just buy and hold. We're in and out, and we'll take advantage of any opportunity on either side, right? So, I think this is the time where, honestly, without, blowing my own horn here, which I rarely do, I don't like to kind of sell myself. I'm not a sales guy. I think the work should speak for itself, and that's the way we operate. Having said that, people that do what I do, CTAs that can be long and short, all currencies, all bond markets, all stock markets, all commodities, all the ags. I mean, the ags have tremendous opportunities. There's El Nino coming. It's going to be a flip from La Nina to El Nino that's as fast as I've ever seen. And that's going to be big for food. And that's another thing that's positive for the metals too, is again, this acquiescence by central banks to higher inflation, and the potential for food inflation to be really sticky. You have a base effect here for energy that could drive down inflation sharply over the next 4 to 5 months, but that dissipates. And if oil is higher than it is now, 5 months from now, you're going to see inflation right back up, man. So that's also bullish for gold. So there's a lot going on. But to answer your question, I think silver is going to outperform here, but you're going to want to have an exit strategy, and you're going to want to be looking for certain things to take profits on that. And to get back into gold, if you want to just hold gold as a safety valve, that's fine. I could see myself, being flat here at some point, but that's at much, much higher prices, I think. So I'm not too worried about that. I think the near term is really set up well. I just hope it's not too obvious.
By near term, are you talking about like the rest of this year or a couple months? What kind of time frame?
Yeah, a couple months, I would say, in through June, the end of June. And then I start to think, what the way the funds forward strip is priced, you're not really seeing any give in Fed funds or any give in the Fed till maybe the fourth quarter. So I think, you start to maybe run into some issues end of the summer, beginning of the fall. You know how it is. I mean, it's kind of a middle of August into middle of October period that could be a little treacherous. But I think for the next 3 to 6 months, it's going to be some time to bank some coin.
In both gold and silver, I assume, and the stocks.
Yeah, both. No, well, I mean, stocks could rally. I mean, yeah, I mean, the dollar down is good for stocks. There's a direct correlation, and right now, it's the stock market is actually outperforming what it should be doing relative to what the dollar's doing. So again, the stock market is kind of out of touch, even with its own positives. All right. I think the stock market, for lack of a better phrase, is on drugs, man. I mean, there's no way the stock market reflects the economic background at all. Okay. It still reflects all the money the Fed printed, 2 years ago, and the optimism around the Fed coming to the rescue that is priced into the back end of the Fed funds market. I mean, look at the 2-year notes below 4%. I mean, the curve's starting to push towards an inversion. Why would that be? Well, if the Fed backs off here early, theoretically, if the Fed backs off with gold at record highs, I mean, think of how that sounds, first of all. But in so doing, it's already priced into the market. So it's almost like, the stock market is pricing in an ease. The dollar is reacting to that, and that's boosting gold. But the stock market may not be able to survive the next stage. So that's when it's going to get tricky. If you see stocks wobble, that'll say that the stock market is saying maybe the Fed won't react to the easy side. Maybe they won't flip the switch back towards easing as quickly as is already priced into the market. And I think that, but it still doesn't necessarily bode ill for gold in the sense that what you're seeing, and you're seeing this in Europe, and you're seeing the UK, you're seeing it in a lot of places. Curves are starting to uninvert, positively sloped, and steepen. Why? Because if you're acquiescing to higher inflation and short end yields are going to come down as inflation comes down and as central banks move to protect the economy, inflation is still high nominally. The long end will pay the price for the Feds and other central banks basically being seen as acquiescing to higher general rates of inflation. That will be curve steepening. And that could cause a problem in the bond market, which could cause the Fed to become even more easy. I mean, the number of scenarios, the number of different directions that this could take is probably the most convoluted. I don't say convoluted because they're pretty clear, but it's the most many potential possible outcomes that I've ever seen. I mean, there's so many different things that could happen here. And that's what makes it so exciting. That's why I have such passion for getting up every day at 2:00 in the morning and pumping out 40, 50 pages of research every day.
I just one more thing. I just want to go back to the 3 or 6 month time frame.
Sure.
I don't, I know that price targets and headlines are great, but I am seriously, as my audience as well, very seriously interested in what kind of upside you could see. I mean, if you're right about the 3 or 6
Sure.
time frame for gold, are we looking at what, mid 2000s? I mean, can silver get above 30 in that time frame, or what do you think the potential is if this move really catches fire here in the near term?
I do, some of the math puts gold at 2650 in this next phase. So, and I think it could happen quickly, could be 2250, 2300 very quickly. So, but I'm targeting 2650. And I think if you get there and we're in a situation where the Fed is just kind of coming into the, shifting of the narrative, you open the door for a run at 3000. You really do. I mean, when you look at all the other things that have appreciated by how much they've appreciated relative to the depreciation in the purchasing power of the dollar, you could make a real solid case that gold is undervalued here. The gold hasn't moved as much as it should relative to what the dollar has done, and certainly relative to what I think the dollar is going to do. So 2650 is a measured, mathematical based target. I think from a psychological standpoint, there's no reason this market couldn't make a run at 3000 in the next, if not the next 6 months, and certainly on the back end of whatever comes. Maybe you get to 2650 by the end of the summer, and I'm just maybe in, because this is what I love to do, and this is what I do with my people. We sit here and we talk about all the things that could happen. What are all the scenarios? I wake up in the morning thinking about this stuff, and that's how sad my life is now. I'm only kidding. I love it, but what could happen? What could happen? What could happen if this happens, if that happens? This way, when you start to see it happen, you kind of already thought about it and you're prepared to execute what you think you should be doing in that situation. So if you get gold to 2650 and it's the end of August and all of a sudden the economy's, really coming off, and the Fed is now all of a sudden the Fed's rhetoric changes a little bit, and or really, I think even more than that, you get to the end of August, the economy starts coming unglued a little more, loosely, if you will. Really starts to come off hard, because frankly, it's coming off hard right now. I don't even know why there's a debate. Are we in a recession? I mean, most of the data says we are. And the Fed's waiting for the labor market, which is finally showing signs of rolling over. And it's the most lagging indicator. It's kind of silly. But if you get to the end of August and, if gold's at 2650 and the economy starts to get hit, then I might start to worry about the stock market being a negative influence. And then maybe you're looking at a pullback to 2200 and then like a buying opportunity that takes you to 3000 sometime next year. Silver, I like silver above $30. I think there's no reason silver stops at $30. I agree with you. 27.30, 28.70, and 30.35. Those three levels are key resistance. But that downtrend line, it connects all those tops back to the 2021 first quarter peak at 30.35 based on the spot futures contract. That trend line was just violated. The most recent high, which was a double top with all kinds of reversal patterns at $25, has been violated. You're broken out. Not only that, the correction from 2020 was a perfect ABC 61% retracement with an inverted head and shoulders just below the 61% retracement, where you kept reversing. There was only 1 week where you closed demonstrably below $20. All right. This thing held like a rock star, then comes up, establishes that high at $25, comes all the way back down to the 50% retracement. So it's ABC and then like a second C wave. And now you got the 52-week moving average rising. You have the 2-year exponential moving average, which is one of the best moving averages out there for trend following, is rising. And the 52-week is moving above the 2-year this week, with silver having taken out that really triple top at 24.77. And the trend line, it goes back to the first quarter 2021 high. I think, it looks like there's resistance. Silver may shock people by slicing through that resistance as if it isn't even there. And you could be $30, by the end of May, for crying out loud.
So sorry to button you down again, but so 2,600 gold. Please. I mean, does that give you 35 silver, 37? I know there's a little bit of resistance there.
Yeah, no, I don't look that way. I mean, in terms of trying to use the ratio to pick a silver price, I mean, I actually think it's just as easy as going, back in time and saying, look, I mean, if you get through $30, I mean, you got some resistance up in like the 37.50 area.
Right there. Yeah, there's not a lot there.
Yeah. But man, you really are talking about a move up towards, frankly, the secondary high after the $50 high was made in 2011, which came in August, which was around $44. So, I mean, if gold's going to be 3,000, silver probably is above 50. So 26.50, $40 silver. I don't have a problem with that.
All right, Greg, before I let you go, please tell our listeners how they can subscribe to your services. Yeah, please just remind us all the work that you do and how people can subscribe.
Thanks. Appreciate that. Yeah. So we do Weldon Live. That's 4 days a week. It covers all the markets, stocks, bonds, currencies, the precious metals, the industrial metals, all the energies, all the ags. It's global macro and market strategy, specific recommendations, and all these things. The SIL and the GDX, by the way, we added a week and a half ago. So that's really performing well. And I think the mining shares, some of the mining shares could really perform well. I did a piece about maybe 10 days ago called The Treasure of Sierra Madre, and using the old Humphrey Bogart movie, what they're bringing the burros down, bringing the gold down off the mountain. It's like, we don't need those stinking badges to participate in this move, right? We don't. So your listeners can feel free to email me at sales@weldononline, one word, weldononline.com, and I'll send them that report, which is pretty cool. I'm also now doing a podcast because the institutional product, we have a lot of, single investors, wealthy kind of individual investors that trade themselves, that love the research, and we give them a cheaper price than the institutions. But it's kind of for active guys. And I feel like there's a lot of people out there that don't manage their own money that really kind of need help. So we started a podcast. It's called Money, Markets, and New Age Investing. And you can find it on Twitter as money_podcast. And we talk about all this. The most recent episode 6, been doing it since November, twice a month. We called this move for all the retail people out there. And I think that they're the ones that are really going to need help, because if you don't own stocks, you are in the camp of, probably lower income. All right. You are paying the price for inflation. I mean, you're really struggling to keep up with the debasement of the purchasing power of your freaking money. And I want to help people with that. And doing things like buying the SLV, 2 weeks ago, buying the GDX 2 weeks ago. I know there were people out there that have already sent me emails yesterday. We got kind of bombed with, thank you. We really participated, really, made some money here. We're really able to start maybe keeping up. So that's the podcast is there too. The Weldon Live is at weldononline.com. There's a free April, we're offering April for free. And it's a couple $100 a month, but I mean, it pays for itself, Jordan. I mean, we have so many trades in there, and I have clients that have go back, all the way with me. I've been in this business 39 years. I'll be starting my 40th year next year. Started on the Florida Comex, moved up to Lehman Brothers as a broker, and worked for one of the most successful hedge funds in the world for a number of years before I started my own gig. So weldononline.com is where you can email me, sales@weldononline, to get the free report on, it's a little old now, it's still a good report on which mining shares we liked, and the entire overview of crypto and the metals as it relates to the dollar and the Federal Reserve and fixed income markets. The podcast, money_podcast on Twitter, or Money, Markets, and New Age Investing on Buzzsprout. And then, of course, I am a CTA, and we are accepting new money. We are very selective in who we take money from. It's not something I really advertise. It's $1 million minimum, and it's $1 million minimum because of my risk metrics are very, very small. And right now, gold can move $40, $50 in a day. $1 million, that's a half of 1%. So, I want to risk a half of 1%, which is, I don't even want to risk that much on a single trade. I need $1 million, not because it's a lot of money, but because that is the amount of money I need to work on risk metrics the way they need to be worked to make sure we're successful. So we are accepting new money at a very selective basis from accredited investors at the CTA. Also, you can just email sales@weldononline for any additional information.
Greg, thanks so much. I really appreciate it, as do my listeners. I will pass along that information to my audience. And hopefully we can have you back in the coming months and do this again as this bull market in precious metals really gets heated up.
Yeah, the gold people are happy again, man. I always like it when the gold people are happy because, I came up in the gold and silver pits on the floor in the COMEX. So, I still have a great affinity for the metals, but, we look at everything. So I think that there's really good opportunities coming, so many different things, if you're willing to think outside the box and take advantage of them.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.